It's been a couple of weeks since the collapse of Silicon Valley Bank and Signature Bank. So where do we stand now? Find out on this week's Video Market Update. So in the subsequent weeks following the collapse of these two coastal banks, the Federal Reserve has set up a program, the short-term bank lending program, which will allow banks to borrow money at favorable rates from the Federal Reserve. That, along with a long-standing program referred to as the discount window, which also allows the Federal Reserve to loan money to banks. Between these two programs, they have loaned out north of $200 billion to banks, mostly small regional banks and credit unions. So if you're a glass half full person, you may say, look, these two programs have been set up, one recently, and they both are working well. People are borrowing money at favorable rates, and that's going to shore up the banking system and provide enough liquidity so that no one has to worry about their deposits at the bank. Someone who's maybe a glass half empty person would look and say, well, why is so much money being loaned? Why do these banks have such a lack of liquidity? Have they all been managing their duration so poorly that there's going to potentially be, again, another run on the bank? I think where we're at right now is most of the contagion has stopped. It doesn't mean that small banks will still not go under, because in a normal year, you'll see a handful of small regional banks or credit unions that are that either collapse or are seized by the FDIC. You and I usually never hear of them because we don't bank there, or it's not a bank large enough to make its way into the news that you and I are looking at. The bigger concern for me right now is the investment banks. So Warren Buffett famously has said, a quote, something to the effect of, when the tide goes out, you can see who's swimming naked. Well, what this banking crisis has exposed is who metaphorically, financially, has been swimming naked. So Credit Suisse, which is a 160-year-old Swiss investment bank, was recently forced to be sold to its largest competitor for essentially pennies on the dollar. And how did this well-respected investment bank get forced to its largest competitor? Because of many, many, many bad investments and many years of writing down billions of dollars of bad decisions. And so how did they stop the contagion? The Swiss National Bank came in and said, we're going to offer a ton of liquidity and we're going to force you to sell to your competitor who's much more stable. In fact, they have earned the moniker Debit Suisse on Wall Street because of how much debt they've been carrying. Another one is Deutsche Bank, which is an investment bank, a European investment bank that we've been watching for years, expecting it to falter, and somehow it just keeps its head above water. So again, the tide has gone out, and it's exposing those companies, those investment banks and banks that have not made great decisions and may not be as financially stable and sound as they want us to believe. So where it looks like the regional banking situation may be contained, and the way we hedge against that is make sure we have our accounts in places where the FDIC insurance will cover it. How do we hedge against these large investment banks? Honestly, there's not a great way, right? Other than owning the stock or not owning the stock, if an investment bank were to go under, it will hurt the market. But again, our hedge against that is to be well diversified, not own that stock, and to make sure that we have a plan in place that could kind of absorb that. So we'll keep watching for this news. We'll keep watching for updates. If you hear anything and you have any questions, let me know. If not, I hope you make it a great week.